Hey everyone, welcome back to the Hashrate Happy Hour Podcast. This show is brought to you by Giga Energy, a leading electrical manufacturer focused on Bitcoin mining. The team over there will get you all taken care of for your electrical infrastructure needs to get your Bitcoin mining operation up and running. This is the very first of a new series that we're launching, and we are calling it the Energy and Bitcoin Mining Monthly News segment. We're going to have on industry thought leaders Collin Kelly, account manager at Luxor's ASIC trading desk, Wolfie Zhao, the founder and head of research for the Miner Mag, and Neal, the director of energy planning at Digital Power Optimization, otherwise known for the rest of the episode as DPO. This format is going to be rolled out once a month on the last Monday of each month, where we will be bringing you the hottest and most relevant news in the energy, Bitcoin mining, and infrastructure industries with the hopes that this helps you identify trends and stay up to date on the latest and greatest news. In this very first episode, we cover the gamut. We talk about the glut of inventory on the secondhand market for ASICs. We talk about what's going on with Bitmain and their cash flow problems. What will it take to get the energy companies moving faster on Bitcoin mining projects? And will we see a flush out of hash rate soon? Collin, Wolfie, and Eric bring so much knowledge to the table that we actually might have to start bumping the episodes out to be longer than an hour just to cover everything and have all the discussion that we want to have. I really hope that you enjoy this new segment of the Hashrate Happy Hour podcast. Please feel free to write in with topics that you want to hear, as we're going to start opening up a poll each month to cover topics that you guys want to hear. And with that, please enjoy the very first Energy and Bitcoin Mining Monthly News episode. Today's podcast is brought to you by our sponsor, the Texas Blockchain Council, a Bitcoin-first nonprofit industry organization working to make Texas the jurisdiction of choice for Bitcoin mining and blockchain innovation. They will be hosting North America's premier policy conference for Bitcoin and the digital asset ecosystem on November 15th through the 17th in Fort Worth, Texas. For more information, please visit their website at texasblockchaincouncil.org. Hey everybody, welcome back to the show. Like I said in the introduction, this is an absolutely special show. It's the inaugural episode of the Energy and Bitcoin Mining Monthly News. We've got a super exciting format where we're going to be doing a roundtable style discussion with a couple of industry thought leaders. We're going to do a quick intro to introduce all of them here in a second. Really excited to bring this format and really excited to be bringing you guys monthly news on some of the hottest topics in the energy industry, the Bitcoin mining industry at large, and the infrastructure industry. And so we're going to get into all of this. You can expect to have all of us on the show. I've got Collin Kelly, account manager at Luxor's ASIC trading desk. We have Wolfie Zhao, the founder and head of research at the Miner Mag, and Neal, the director of energy planning at Digital Power Optimization. You'll probably hear us say DPO for short as we go through the conversation. But guys, welcome to the show. Super excited.
Thanks for having us, Ben.
Yeah, great to be here.
Yeah. Awesome. So we all know the format, guys, but for the audience, how we plan to go about bringing you guys news on a monthly basis is we're going to kind of just go around the table as the round table discussion name suggests. And we're going to have each of the industry thought leaders, Collin, Wolfie, and Eric, give you guys an update in each of their respective fields. So Collin, if you're okay to kick this thing off with some of the news in the infrastructure and the ASIC space, and if you don't mind going first.
Sure, I'd love to. So my specialty really lies in the hardware side of things, specifically ASIC miners. And we get a great pulse of the ASIC market at the Luxor ASIC trading desk, especially through our RFQ platform. So I think there's a few really interesting things happening in the ASIC market right now. One being, and I think Wolfie wanted to comment on this as well, as the Bitmain S21 pre-orders. And I personally have have some thoughts there, but as a whole,
Sure.
what's happening is, Bitmain did this large announcement event, and they came out and promoted the S21 with a super nice price tag on it of $14 per terahash, but with a very large minimum order of quantity. So they're advertised, if you want to get that $14 per T, you got to meet a certain minimum order of quantity. Well, that's around 1200 petahash or 1.2 exahash, which is
That's a lot.
yeah, it's a very high barrier for entry, especially when a lot of the market, depends on secondary participants maybe buying 5, 10, 100 miners. So I think for me, it set this really high barrier of entry, and what happened after that? So after the announcement, we kind of immediately saw the ASIC market start to react, and
Mm.
pricing for the S19 models changed fairly dramatically overnight. Some ranging from a 7% price decrease to a 14% price decrease across some of the newer models like the S19K Pro. So it's
Oh, wow.
yeah, it's definitely shaking up the ASIC market, and curious to hear Wolfie's thoughts on how Bitmain has structured the S21 pre-orders and what you're kind of seeing on your side there.
Yeah, I mean, certainly, like we at the Miner Mag, we kind of started this like a Telegram channel where we curate like mining news and data analysis, and we also put out all of data on our site. So like if I kind of look back the posts that we sent out like over the last month, like the Bitmain news was like the most clicked and shared, or that's one of the top. So definitely a lot of interest there. And the thing that was super interesting to me was that Bitmain was actually willing to give like maybe 20% of the loans and credit, like basically, and like financing this kind of purchasing of pre-orders. I think over the last cycle, like I didn't see anything like that and that kind of scale. So they were funding, I think 20% of the pre-orders from CleanSpark, which won't be due like after 1 year, like 1 year after the delivery of the machine. So it's kind of
Oh, wow.
a really big effort to make to attract buyers. That kind of coincided with their news, right, about their internal leaks of the cash flow issues that suspended at least like for a couple of days of their employee payments for September. And soon after news picked up, they kind of made the payments whole because like they kind of went into a PR, I guess, like crisis, because it kind of looked back before in front of the customers. But yeah, that kind of speaks to the kind of demand, the need for new cash flow to come in to sustain the bear market and also like pay for the wafers.
Yeah, it's a
And
great.
this is just to jump in, and this is probably for both of you guys. How is the like glut of inventory in the market for ASICs affecting that too? I mean, I'm sure that's having a lot of downward pressure on them as well. Just the fact that there's so much inventory.
That
Yeah.
Yes, absolutely. And another interesting fact is that they released in my eyes, the best bang for your buck model right before they did the S21 announcement, and that's the S19K Pro. Clocks in at 120 terahash. It's 23 joules per T, and they're under. I mean, you can get them delivered in the U.S. for around $13 per terahash. This is, a 40% price difference from an XP with very similar efficiency, and in my eyes, is probably the best miner on the market as far as value right now, which it has to be eating into S21 pre-orders, right? And these machines are fresh out of manufacturing. They're hitting the secondary markets hard. All the big brokers in the space are taking large inventory of them. So it's from a strategy standpoint, it just was kind of shocking to me that the timing of the release of the K Pro and the S19 JXP and these other couple little models right before the S21. So interesting.
Yeah. I mean, I periodically track the miner imports to the US. I think over the past like 6 months, there were tons of S19 XPs being imported by Bitmain's US entity. So I count like probably over 30 exahash of XPs that was just imported by Bitmain itself to their warehouses. And I think like a lot of them might just be sitting there.
Wow.
Some of them maybe have been picked up by self-picked by customers, and some of the I think Bitmain is also plugging in themselves. So definitely, yeah, there's a flooding of inventories. They're waiting to find homes.
Wow. That's a pretty incredible number of XPs that were imported. It's
and I think I found like a couple of others being importing heavily as well. Like, well, I mean, not as heavily as Bitmain itself, but like ASIC, Galaxy, they have also been importing a lot of S19 XPs. Yeah.
And what we're seeing as far as XP price, for the last probably 4 months, XP price has come down pretty dramatically. They were trading, closer to the beginning of the summer, they were trading around $23, $24 per terahash. Now we're getting down to under $20 per T for the first time that we've seen. So I think it's a function of a couple of things, right? The new models getting released. Also, you got the bigger, badder, more efficient models on the horizon. So, and then, like Wolfie said, it seems like there's a surplus supply of XPs right now.
Yeah.
Are we, guys, are we at or below historic dollar per terahash levels on equipment right now? Or so I'm thinking back to like, this is my first cycle, in the Bitcoin mining industry. In the last one, did we get lower on a dollar per T basis for hardware?
So it depends on which efficiency class you're talking about, right? For something like an S9 or similar, yeah, these things are pennies now. And I believe we're putting in new lows. When you bump it up to the next like efficiency class, maybe talking around 30 joules per terahash, so J Pros, M30S++, these kinds of models, absolutely, they're historically pricing is at all-time lows for new and used models. So it's a whole different ball game right now. And then you look at mining economics, and Bitcoin network hash rate is absolutely ripping to the upside. Difficulty is putting all-time high after all-time high. So yeah, I mean, it makes sense that these lesser efficient models, they're going to be earning less Bitcoin, therefore their value is lower. So yeah, it's really interesting times right now.
Yeah, I think I remember maybe around like July, August 2020. It was right after, like a couple months after halving, and just months after Bitmain rolled out S19 series. I mean, at that point, hash price was also maybe like $80, $70 per terahash.
Yeah.
At that point, right now we're even lower than that.
Yeah.
But I mean, at that point, I think Riot and Marathon, they pay maybe like $22 per terahash for like pre-orders. So like won't be shipped until like maybe 6 months later. So I think it's probably in a similar scenario, right? Whereas was close to the pathing, close to the launch of the next generation of equipment, and close hash price range. But now we're probably even lower than that.
Yeah, and it has a lot to do with hash price too. I mean, we're approaching the all-time lows of hash price. So it's a difficult time to be a miner.
It's hard out there. It's it's tough out there. That's for sure. Wolfie, maybe just to go a little bit more on the whole Bitmain and kind of their I don't know if it's a cash crunch or what they're feeling. I did get a chance to hear you on the Miner Mag, or excuse me, the Mining Pod with Will Foxley. Was that pay scenario with their employees, was that all like base compensation? Because I know Bitmain has like a split pay structure, right? Maybe go a little deeper on that.
Yeah. So I think like for in the past, like I think they pay like a fixed salary. Like if you have a job as an engineer, you have like a salary package and you get paid every month. It was a fixed amount. I think around like earlier this year, they kind of changed the payment structure where you have like a base salary, and the remaining part of your salary is based on how much of your KPIs have been fulfilled. So depends on like what kind of departments you're in. You have certain KPIs that you have to meet. How much of the salary you can get from that part depends on what's the progress of your KPI. And so after, I think that's probably the kind of the impact of the bear market, right? So
yeah.
I think what happened in September was like some of employees were complaining on social media in China that their base salary wasn't even paid in full. So you already changed the structure in terms of the performance, and now you're cutting some of the base salary. So people they got grumpy and people weren't happy about it. So someone went out to social media in China and complained about it. And then Chinese media they picked up the news and then spread into the English speaking world. And after a few hours, they kind of made the payments full. And I think the initial internal notice that sent to employees was that some of the KPIs weren't fulfilled, so we're holding some of the payments, etc. And because they were having like negative cash flows from operating activities, they mentioned they alluding to some of the problems with miners' deployment process, which I think refers to like the miners being deployed to their mining farms, or at least the mining farms with their partners. So that's part of their operating activities that haven't really generating revenue, or that's my guess. And then I think after like a few days, they fired those people who went on to social media and chat about it, and they were like, "Don't like without company approval, do not speak anything about Bitmain." And then that notice got leaked again. So
sure, that's just really another funny. Bad luck.
It's very interesting. So it's known for like not being transparent at all.
Yeah. I don't think that's too uncommon for them. I don't know that they've had a ton of transparency in the past either, but
no.
I do wonder if some of these large mining companies are evaluating their fleet, because when you think about like a publicly traded mining company, growth is really the path forward. And growth looks like adding to your miner fleet. I wonder if they look at having like the largest supplier in the market having cash problems as a liability, or I wonder if their investors and their shareholders in the companies are asking questions about the where they're getting equipment. I wonder if those conversations are happening.
It's a good question. There are only that amount of ASIC manufacturers, unfortunately. And if the biggest one really has some cash flow pressure, then I would assume that smaller ones would have something similar too.
Yeah.
So, yeah, I think in the past it's like there aren't many choices anyway, and there aren't many choices in terms of like ASIC manufacturers and the choices of wafers, like where do you get your foundry. So it's kind of the bottleneck of the industry. But
And then
it's good to have see a lot of more startups, especially in the US, trying to make some efforts in launching that. I don't know if they will succeed or not at all, but it's good to see.
Yeah, Wolfie, do you know why it's so hard for new companies to make an entrance? Do you have either a hypothesis or like a high level understanding of why it's so hard for new entrants?
Well, I'm not a chip expert, but based on my understanding, it's like a hardware engineering. You need the ASIC, you need the chip designers that understand how IC design works, and then you have some industry problem with the foundries, and there are only that limited amount of foundry manufacturers, and they are prioritizing the traditional industry over like Bitcoin mining. Like if they can make phones, if they have enough orders from Apple, like TSMC, why would TSMC allocate a lot of wafers to Bitmain or Canaan? So yeah, that's always the problem. The
scale. So it's size and scale of the orders.
Yeah. That's unfortunate.
And now a quick word from our sponsor. This show is powered by Giga Energy. Giga Energy is a vertically integrated Bitcoin mining company that manufactures all of the electrical infrastructure needed to start mining Bitcoin. Whether that's medium voltage switchgear, PDUs, or power cables for your miners, the team at Giga Energy has you covered. Reach out to their sales team today for all of your electrical infrastructure needs at sales@gigaenergy.com. Use the word hashrate for the subject of the email, and you'll get 5% off your order. All right, now back to the show. Yeah. I think, you kind of alluded to part of the problem is the fact that the miners aren't deploying quick enough to have the incoming orders for Bitmain. And Eric, I think that kind of plays into maybe some of your realm and your world is, and then, I'd love for you to maybe share what you were planning to kind of share coming to the table, but what are you seeing from like a building and energizing perspective in the US for new miners? You guys have your finger on that pulse pretty good.
Yeah, I think we're starting to see some of the supply opportunities play out that DPO has been sharing with some of its prospective clients for the last year and a half, 2 years, that eventually we're going to get to this point where we have older machines, we have a surplus of machines that can't run profitably on the grid at, typical grid power prices. And those machines are going to try and find a home. And the best home for those is areas where you have challenges on the grid, transmission congestion usually. And, anyone with resources in wind country in the middle of the US understands transmission congestion and challenges with getting new transmission interconnection capacity for new renewable additions. And this is great for that. And DPO's kind of been saying it'd be really great if you had some infrastructure already established to put a bunch of these machines that are available on the ground to start soaking up power and deal with some of your negative LMPs. And what DPO has been trying to do to help the industry get ready for this, as well as make use of equipment that's been around, for the last couple of years, is kind of approach things from the energy company side of the business. And anyone who does any activity in Texas is probably aware of the Texas Blockchain Council. Now there's an Oklahoma Blockchain Council, and they're attacking the opportunity for states to engage in this industry largely from the legislative level, which is really important. DPO's engagement is a little bit more behind the scenes on the regulatory side, right? And every state's a little different, but there's this interplay between legislative activity and kind of regulatory implementation of legislative rules. And the regulatory space, especially in states with regulated electric territory, it's critical to have, again, it's kind of behind the scenes, right? Regulatory stakeholders don't go out and engage in the public domain with what they're doing to advocate on their customers' behalf, right? Some of that stuff makes it out to the public domain, but a lot of it is kind of more closed door conversations with their stakeholders and the utilities that are affecting their stakeholders. And that's where DPO is trying to get engaged and get some attention and help people understand that your customers would really benefit from some of this technology being on the system. And here's how. And I shared my background on episode 12 and kind of went into how do these regulatory stakeholders think about these things, and it's very differently. And we're just continuing to get our message out there. I was hearing all-time lows on, price per terahash. Okay. That's bad in some circumstances where you have expensive power, but it also means a very inexpensive supply of load that you can deploy behind the meter, whether it's vertically integrated or through some kind of a low-cost PPA, and soak up this excess power. So it sounds like it may be challenges in some markets, but opportunities for energy companies to invite this stuff into their service territory and make use of it.
Maybe to jump in, Eric, I've got kind of this is a self-serving question. I recently have been engaging with the vice chair for the Minnesota Public Utility Commission, and he's extremely interested in kind of all of this. Bitcoin mining, the usage on the grid, everything. Interestingly enough, the Twin Cities in Minnesota just signed the fourth or fifth largest load customer is now going to be Facebook. They just dropped soon to be dropping a gigantic data center here in the Twin Cities. How are you guys talking to folks like, the PUCs? Because when I've been having these discussions with him, he's very focused on ancillary services and renewables, and not so much a focus on like demand response, which I think is where, Bitcoin mining is going to step in a more impactful way. What are those conversations like when you're trying to talk to someone like that?
Well, they're kind of all over the board. I tend to focus in DPO on the energy side of the equation. Our founders are going to be talking a different language than I do, just based on my background in regulated utilities. And I guess one common theme when we're engaging on topics about some of those hyperscale data centers is, if you're okay with that, you should be okay with Bitcoin, because the availability of somebody's TikTok photo, being available, or Instagram message being available, or that picture, the 75 pictures of your dog you took yesterday. If you're okay having power used to make those things instantly available to everybody is acceptable. Like, if you're fine with that, consider the idea of also being fine with a data center that runs a network security platform, right? Like, it's probably, according to some, more valuable to society than, 75,000 photos that you're probably never going to look at again, but are available at an instant.
Yeah. Okay. Yeah. The other thing that we kept kind of bouncing into is Minnesota has not very advantageous power rates. Even at a commercial level, even on a time of day kind of rate structure. But what we kept bumping heads about was he would tell me that they can't, like, regulated utilities can't go below their cost to produce the power. And it's just, what was shocking to me was, it's like, well, I look at Texas and ERCOT, which, yes, it's a totally different grid system, but you can tap into 3-cent power down there, 4.5-cent power, 3-cent power. But up here, I think the best you're going to find, this was a little while ago that I was actually really digging into this, is best you're going to find is like 5.9.
Yeah, that's
a big difference.
That's a debatable topic. Like, what is cost, right? There are different ways to define cost. And there's a book that, it's probably been 15 years. I think it's called The Goal. And it has to do with I think, and I might be representing the wrong book, but there are books that are written about identifying bottlenecks and identifying your incremental cost to produce an additional widget. And I think deregulated markets are better at identifying those opportunities to make use of available infrastructure and get that next incremental megawatt hour delivered at a price that makes the system whole for that next incremental megawatt hour. And in regulated jurisdictions, whether it's T&D infrastructure or generation or distribution infrastructure, it's more of a class cost of service approach that says everybody in this cost category has to pay the same. And it's not very effective at recognizing the unique capabilities of the loads within that cost category. And I think the regulated electric industry is still trying to figure out how to kind of pigeonhole this load into an existing cost category the best that it can, while recognizing that it doesn't really fit well into any category, and we need to treat it differently because it can do stuff for the grid that other loads can't. Right? There may be examples of other large loads. I haven't heard of any that can behave like this. And we keep telling people, again, we went into it on episode 12 in a little more detail, but it's essentially a battery that can charge 24 hours a day. It can't discharge, but it can behave very similar to a battery. And if you like batteries because of what they can do for your system, at least model this load in your integrated resource plan and in your ProMod studies and your Aurora models and whatever you're using to model customer cost and customer value. Stick this in there. You don't have to like it. You don't have to dislike it, but at least understand it. Put it in there and see what it does for your system and see how it augments your expansion plans. Do you still need that transmission expansion if you have 500 megawatts of this stuff in a load center where there's tons of congestion? I don't know, maybe not. But if you don't ever ask the question and study it, you don't know. And I think the industry is still very early to adopt innovative thinking about how to look at this stuff.
I think that's a good jumping off point then, Eric, to ask you, how are things going in your discussions? You guys are doing some pretty cool work down in Oklahoma specifically. Maybe touch on like how are these conversations going around all of that?
I'll say, without getting into details that
Sure.
would disrupt some of the confidentiality that we have in place, because it is kind of a sensitive topic. When the entities that we interact with which are largely energy companies and independent power producers, when they don't have a clear understanding of how these regulatory stakeholders are going to respond to the desire to deploy this infrastructure, they're understandably very sensitive about talking about it in the public domain. So I'll refrain from any specifics and just say, generally, we're getting a broader audience and more receptivity on the utility side of these discussions. And we think we're making progress. Oklahoma is a good state to bring up because of the Oklahoma Blockchain Council starting to get a little bit of press, on LinkedIn and elsewhere, that it's trying to advance some things. So, all right, let's attack things from both fronts and try and help everyone understand what's going on there. And, DPO has interests in engaging that regulatory advocacy group. There's a regulatory docket that was opened about a month ago where the Oklahoma Corporation Commission Public Utility Unit, I believe, is the one that actually filed the docket and said, anyone who has any ideas for innovative rate making approaches, give us your ideas, right? Submit it into this docket for us to review. So regardless of what's going on the legislative front, and maybe that was influenced by some things in the state Senate that said, hey, go open a docket. That might have been the genesis of that, is go open a docket to get some innovative rate making solutions on the table, because we have a bunch of people that are telling us, there's a bunch of opportunity here and we can't make use of it because of the rate structure. So try and fix
Sure.
that. So that activity is underway, and DPO wants to be a part of it. But again, it's usually behind the scenes in conversations with folks that don't want to be in the public domain, but really want to have a voice. And a lot of that happens with those consumer advocacy groups that I'll say kind of get in the way sometimes, but it's not in a bad way. It's to try and protect the interests of the stakeholders they represent. and they ask tough questions, and they make sure that you have a good idea before they say they're okay with it. So, those conversations are in a lot more detail. And again, they're not in the public domain unless it's a contested case regulatory docket. And even then, most of the information is filed confidentially. So we're just trying to have an influence there and help people really understand what this stuff can do. And, the market conditions with this excess supply of load and nowhere to put it is so relevant to that conversation. So we're hoping that we can help Collin and Wolfie, have a different message next month that, wow, we found a home for all this stuff, or we're finding a home for all this stuff in areas where we could really use some load.
Yeah, I have a follow up. Like, what do you see is the biggest challenge to get them convinced to make some major move to leap forward? What would the industry take to convince them?
I'd say the biggest lift is demonstrating the facts behind the argument that their stakeholders are going to benefit from this. There's a large concern about a bunch of new load causing the utilities to require additional generation investment that other customers are going to have to pay for. And that's particularly concerning when folks say, is this load going to be here 3-4 years from now when that new generation comes online? Like, is somebody else going to be stuck with the bill? And those are legitimate concerns, and it requires some sophistication in how you tell the story with data and modeling to say, this is how this load behaves. It's not going to cause the need for additional generation investment. It's going to actually alleviate some of the problems that are on the grid today without contributing to new problems on the grid tomorrow. And again, when you stick these loads into existing tariff products, it's really hard for them to come to that conclusion, right? That conclusion requires a different product that requires this load to behave differently. And again, marrying those two up where they understand, oh, I get it now. I understand through the economic lens that I look through that this is actually a good thing. And we need to create, or at least advocate for, the creation of new energy products that allow this load to get deployed the way that folks are telling us it's actually beneficial.
Yeah, I guess it's also still early. Like, is it like challenging to get a real case study to present to them? Like, this is what actually happened, to prove that will be like a much stronger case, right?
Texas, man, Texas is the case study.
I'm also wondering if showing them what happens when some of these companies go bankrupt, look at what happened with Compute North, but then you had US Bitcoin swoop in, you had companies come in and pick that infrastructure up, and and Texas.
Yeah, Texas is a great case study. I mean, home to 17% of the global hash rate. And it's been amazing to see what large flexible loads can do. I mean, I know you recently had, I believe, Neal from ERCOT.
Yep, Evan and AG.
Yeah. And I mean, his work is a testament to that. We're seeing actual real benefits from these large flexible loads within the ERCOT system. So, what better case study than the Lone Star State, man?
Absolutely.
And sorry to jump in. They actually had it was a really good conversation with them, but there's a lot of undertone of concern, very serious concern. Maybe more of that was shared offline of that episode, but it was we're a little nervous about what this is doing and how this is responding. More around ramp rates and just the actual balancing of the grid.
So it will takes time to actually show.
Yeah, Eric, I don't know. Are people concerned about ramp rate and frequency balancing and things like that? Or is that even does that hit your radar?
It does. And, at the 10,000 foot view, the idea is that's what the markets are for. The price signals are supposed to incentivize investment in the right technologies in the right places. But the reality is, not every market is perfect, and there are opportunities that are out there that are not incentivized by these price signals. Some system operators incentivize responsiveness more heavily than others, but that doesn't mean the opportunities don't exist in those other markets. And the regulated utilities that actually have customers to serve have a very solid understanding of what it takes to serve those customers and can approach this differently with vertical integration, where you're not relying on a market signal to compensate you for value. You're vertically integrating it and demonstrating through your own portfolios, models that I'm better off with this, or my customers are better off with this. So there's a bit of a market push, but there's also other opportunity to bring this in without waiting for the markets to create the price signals necessary to incentivize the right behavior. So I guess that's a little bit of a plug for, I see value in regulated markets. I also see value in deregulated markets. It's not that one's better across the board than the other. Maybe they can learn from each other on how to do this. And Texas is definitely a use case, right? You can certainly see the responsiveness of the technology.
Yep.
How fast can this respond? How much load can you get out of the way? The other use case that we're really hoping to see is that regulated jurisdiction that, puts, and they're starting to come. You're seeing your tariffs that are designed for large flexible loads in regulated jurisdictions, but I think there's a little room for improvement. And, these regulators point to each other and say, well, this jurisdiction did it over there and their customers seem to like it. So maybe we're open to an idea that looks like that. And the more of those regulatory precedents that you see pop up, I think the easier it's going to be for other jurisdictions to adopt something similar.
Yeah, it's like you were saying, Wolfie. It's it's just get the case study, all kind of put together, and like you were just saying, Eric. It's hey, they're doing it. Let's try what they're doing. This is a little bit of a transition, but there was that article by JP Morgan. I think it was a full-on report. I couldn't actually find the report from JP Morgan on Bitcoin mining, but I saw a bunch of summaries and of that report. Did you guys get a chance to read it?
Yeah, I looked through the reports. It's like a 60 pages, like a PDF.
Oh, you actually found it?
Yeah, someone sent me.
You'll have to email it to me afterwards if you don't mind. I'd love to actually dig into the real report. Yeah.
So I think a lot of the information there is kind of introductory and kind of background introduction of a lot of the how it works. I think the audience for that is their customers, professional, institutional, or individual investors. So it's not super technical.
Oh.
They did have some projection of the hash price and hash rate based on their own assumptions, and then they evaluated. I think it was Marathon, Riot, CleanSpark, Cypher, and one more, maybe Iris Energy. Basically evaluate them using couple of different metrics just to show which one is their top pick and how they. So it's basically like JP Morgan initiating a coverage, and this is their top pick. Well, basically they said the top pick was CleanSpark, and then they put very neutral or what's the word, underweight in terms of Riot and Marathon, etc. So I think the information there is kind of basic, but it's interesting to me that JP Morgan is actually initiating coverage for mining stocks, because I think over the first half of the year, mining stocks perform exceptionally well compared to Bitcoin's rally, but then starting from mid-July, they all plunged more than 50%. They're now bouncing back a little bit. But yeah, it's just I think JP Morgan itself covering this thing is kind of interesting, because I think in the past, like people see the investing in mining stocks, it's just like a proxy of buying Bitcoin, and maybe it's a levered play. You get a higher volatility in relation to Bitcoin. But then you see more and more these sell side research start to focus on different mining companies, and they look into different metrics. And I think it's good for like industry to for investors to realize, these mining companies, they have differences. They have different business strategy, their hosting strategy, or self mining strategy, or treasury strategy, different kind of things that makes them different. And some of them would go bankrupt. Some of them would have like a really emerge as like a stronger after the bear market, right? So I think does that, it gives like a better presentation of how the industry looks,
definitely,
in terms of diversity. So
and also what I'm noticing is it's not just JP Morgan. A lot of these other big firms are coming out and putting so Fidelity, which I was really impressed with their report. They just did a 23-page report called Bitcoin First Revisited, and why investors need to consider Bitcoin separately from other digital assets. So what does that mean? Bitcoin, not crypto. And that's what, all these maxis and people that have been in the space for a while have been saying for many, many years. There's Bitcoin and then there's everything else. And to see this kind of positive tone come out from somebody like Fidelity and really just lay out why Bitcoin is different from all these other crypto assets. For me, it's refreshing to see. And because, the FTX and all these scam coins, they do damage to the ecosystem and how people view Bitcoin. So seeing this kind of research come to light, I think it's extremely welcomed, and I think they're doing good work, kind of laying it out there for people that may not be as tech savvy or involved in the space.
100%. It's, I mean, I think, just from like a foundational aspect too, the proof of stake is not helping stabilize a grid system or providing value to the electrical grid. So, I mean, even boil it down to like just infrastructure and like true utility, it's helping there too.
And also just helping people understand that there's the Bitcoin network and also the Bitcoin asset, and price isn't necessarily tied to the Bitcoin network. And I mean, I talk to friends and family and they're like, oh man, Bitcoin price is still down, and I'm like, yeah, but have you seen the hash rate of the network? We're at all-time highs. It's getting bigger. And so that in my eyes is a very positive sign that adoption is happening, and you see that through the miners.
Do you guys think we're going to have a flush out? I mean, the hash rate it's ridiculous.
I mean, yeah.
So,
yeah, go ahead.
I was just going to comment. Yeah, I mean, I've talked to some of the other guys at Luxor, and it seems like we are expecting that there will be some hash rate capitulation around the halving. And so what does that look like? Well, if you look at historical halving events, you see a large drop off in hash rate, but it also recovers eventually. So it's tough to see it's hard to say exactly what will happen as we approach the halving, but I can tell you what I am seeing from like a strategy standpoint and how miners are preparing for the halving. And one of the most common themes that I'm seeing right now is firmware optimization of your fleet. So what does that mean? Installing third-party firmware, like shameless plug here, like LuxOS.
I was going to say, Collin, come on.
Yeah. And what does that allow you to do? So it allows you to do a couple of things. One, tune your machine to be as optimize and efficient as possible. And then you also have the optionality to over and underclock. So someone with a favorable electricity price and maybe some older, less efficient machines, they might be thinking, I want to get as much Bitcoin as I possibly can out of this 6.25 block subsidy before it gets halved into 3.125. So what do? They're overclocking the machines and they're ramping them up and they're just trying to squeeze as much Bitcoin as they possibly can out. And then you've got another strategy, which is to be efficiency focused. And so we see people underclocking the machines to capture the efficiency gains, kind of reduce their power costs a little bit, give them a little more wiggle room and runway as we approach the halving. So I think there's some great and just really creative strategies. And everybody that I've talked to, a lot of operators have their own spin and how they're doing this. So some really incredible creative strategies coming out as we approach the halving. And then the other one that we're seeing mostly with larger miners that have cash available and rack space available is fleet upgrading. So getting rid of your over 30 joules per terahash machines and upgrading into something like a K Pro, an XP, or an M50S++, and really focusing on efficiency there. And we have, the Luxor RFQ data is totally backing that up. Last month, S19 XP was the hottest model. So I think, if you want to be efficiency focused going into the halving, you got a couple options here. Firmware optimization, underclock your rigs. 2, sell your old rigs, get what you can for them, and upgrade into the newer models. So yeah, it's I definitely think we'll see some consolidation amongst the miners as we hit the halving.
Yeah, I think I would call the JP Morgan report. They said they estimated 80 exahash would be reduced immediately after halving. But yeah, the firmware is like really brings the history back. I think around like summer 2020, it was a time like BTC.com and Ampool would. They even rolled out their firmware to underclock the S9s. It's kind of really.
I didn't even know that.
Seems like very very long time. Like you would underclock an S9. Seems like unthinkable right now.
Yeah.
But
from 13 from 13 terahash down to 9 terahash, and still probably like well over 60 joules per terahash in efficiency.
Yeah. It was a fun time. Like I was seeing the Chinese miner. I was like trying a lot of different ways. It's like it was so like now it's from it's from 13 to like maybe 9, 8. It's like just a couple of terahash difference. But yeah, we compile this data about cost of Bitcoin production basically on every public mining companies in terms of their self mining business. So that's based on their cost of revenues every quarter, excluding the depreciation and any other cash based expenses. This is like raw energy and maybe side expenses, so not even including the OPEX. And I think the median is around like 17K per Bitcoin mined.
Wow.
There are some lower ones, maybe like sub 10K. Higher ones like even above like 25K for energy and side maintenance. So I mean, now the hash rate is going up. So if we assume that the energy rate they have like kind of steady, then their cost of Bitcoin production is gonna be higher as we go into the halving, right? So maybe like edging towards like 20 in terms of like the medium cost of production, and then after halving it's gonna pump up. It's gonna be like 30, 40K. At that point, if Bitcoin prices isn't really showing any like upward trend, then it's going to be hard. A lot of them going to get wiped out. So yeah, efficiency and it's what matters.
Yeah, I think when you look at the balance sheets of a lot of those publicly traded guys, where you can look at the balance sheet, there's a lot of them running really lean right now too, from like a cash reserve standpoint, or if they're doing like a hodl method, there's a lot of them that are pretty lean, right?
They're either lean or they like expand at the expenses of their shareholders, like just diluting the equity and borrow money. So I mean, there's no other ways. Like selling Bitcoin itself probably isn't gonna. Well, I think selling Bitcoin is enough to cover the OPEX right now for a lot of them. But like in terms of like expansion, they would definitely need more like financing tools, either equity or debt, or a combination of both. So I mean, debt financing isn't probably that attractive right now. So
yeah, high interest rate environment is it's not really allowing for a lot of that to even be considered. Yeah.
So Wolfie, you mentioned that JP Morgan is estimating an 80 exahash pullback in network hash rate at the halving. My thought is, okay, how do you get there? And what would be really interesting to dive into some data is what is the composition of the global network as far as ASIC? What models are still out there? We know, I know here in the US, a large majority of active miners right now are in an S19, maybe 90, 95T or a J Pro. And, looking at some numbers that we've run at say, the average hosting rate is, let's call it 7 cents kilowatt hour. After the halving at 7 cents, a J Pro is losing money. So are, we know S9s, S17s, those are already on their way out the door. I think these J Pros might even be the next to be phased out as inefficient not making profit machines. And so if that happens, I think, maybe it's more than 80 exahash, because a lot of the fleet compositions that I see, like I mentioned, are S19 or J Pro.
Yeah. I mean, if you think about from the bull market since 2021 and 2022, I think the hash rate was up like more than 100 to 200 exahash. Like it went up that much.
Yep.
And a lot of the contribution came from the S19 series before the XP.
Yep.
So, yeah. I mean, it's probably going to find it somewhere in like there will be some equilibrium where with the hash rate is like going down so much and everybody's turning off, and then the hash rate will be down so much and then it kind of becomes profitable again. So there might be a period of time where people have to switch on and off rather regularly until like there's a bull breakout. I think that's the same what happened to S9 throughout like 2020 summer. Like a lot of the miners were like powering on the S9s and then shut it down. You have to like try to find the lowest cost to keep them up and running, but
so
it's not happening for everyone.
Do you guys see eventually the production and publication and management of like a dispatch stack similar to an energy market, right? Because energy markets, your price signal is your LMP, and your generator has an efficiency and a fuel input cost where, like at a certain market price, your generator is not going to be online, assuming it can, ramp up and down. It's very clear. There's no question about whether you're going to be in the money or out of the money. And the whole market has pretty good visibility into what that dispatch stack looks like. If you say in PJM, if the LMP drops below $30 a megawatt hour, how many generators are still going to be profitable? I don't think there's a whole lot of debate. It's just, it's known. that dispatch stack is well understood. There seems to be a lot more guessing and secretism, if that's even a word, in the Bitcoin marketplace about, I don't know how many miners are going to shut off, and why don't we know that? Why isn't there more transparency in the marketplace so that we can do a better job predicting the deployment of this infrastructure and how to operate it?
A lot of it has to do with the manufacturers and how secretive and closed door they are about production. So I mean, we can only estimate how many S19 XPs Bitmain manufactured.
Every month. Yeah.
Every month, is it 30,000? Is it 60,000 machines? You can only kind of see what's going on in the secondary market, talk to the other Chinese brokers that are close to Bitmain. So it has a lot to do with the source and distribution of miners. That's really hard to see. But when you get into the cost analysis, we know where an XP or a J Pro is unprofitable. We know at what, kind of electricity costs and at what difficulty adjustment these machines are like, hey, you're losing money. But getting a good understanding of fleet composition and how many miners are truly out there, that's very, very difficult to do without, just looking at overall global network hash rate.
Yeah. It's actually right now is like a lot better than when a lot of miners were in China. Like they would now, at least you can see from the public mining companies, they will disclose like this is the kind of fleet we have the efficiency we have, how many miners we have, blah blah. In the past, it's like there's no such thing. Like everybody's operating in secrecy. Like they probably know each other, but they don't really, like there's no way to find all the information about their operation size, their fleet efficiency, their energy rate. So there was like entire black hole, like a black box in terms of data visibility. And like what Collin said was like absolutely right. Like miner manufacturers, they want to keep their production very secret because they don't want to tell how much wafer they get from their foundry factories, and they don't want their competitors to know what is their production scale. Yeah, it has been like that for a long time.
Yeah, Eric, do you think that would be another piece to kind of unlocking some of the conversation with like regulators and utilities? Is that why you asked?
I was asking because I'm optimistic about the eventual convergence of the Bitcoin marketplace and the energy marketplace. If this is truly going to be an energy management technology, that transparency is going to help energy markets anticipate the utilization of this and not guess about the quantity of load that could come online or go offline in a, I'll say, a perfect market. And it's a global marketplace. How you predict your day ahead and real time operations is very influenced. Now, granted, the time scale of profitability for Bitcoin miners is very different than a 5-minute energy marketplace. But eventually, I think we get to a point where the time scale isn't that different, and maybe the day ahead dispatch incorporates this global marketplace better than it does today. And there's less of, I wonder how it's going to perform. And it's more of, I know exactly how this is going to perform if everything's running properly.
Yeah.
I would say, if ever like Bitmain or MicroBT, if they go public, I think that will give us like a lot of more data visibility because, well, in terms of a Canaan, they do disclose the amount of ASICs, the miners, by model, how much they sold every year, not by quarter but by year. So like they'll break down from 2017 to 2022, like every year, what is the model of A7, 8, 9, 10, 11, how much miner in exahash they sold. So I think that gives us a lot of visibility into like how many Alamo miners are out there over the years. So if Bitmain or MicroBT they do the same, then I think the network can benefit a lot from such transparency.
And Wolfie,
it's
if you
just
had
like right now there's a lot of secrecy.
if you had to guess, do you see Bitmain or MicroBT going public?
I mean, I think over the last over the last like maybe 2020 to 2021, there was like a lot of talks about them going public because they need cash, and then the bull came, right? So
Same,
and
yeah.
there was like an internal war inside Bitmain, so like there's no reason for them to raise cash, and then they split the bid deal, so like external investors went there to cash out. So now I don't see any reason for them unless they really need cash.
Which we may be
like
edging closer to that, right?
Yeah, if you have enough cash to keep the business running, then why do you go public when you prefer all of the information to stay private? Right? It's a little hazard.
Sure.
But I hope
yeah,
they do.
No, it's a fair point. Well, guys, just to keep a tab on the time, we've been going hour strong here. We're all very busy. Wolfie, I think you're looking to wrap up your evening, so I think this is probably a good stopping point for the first of these discussions. I think we just touched on a lot of really, really, really good stuff. So I really appreciate you guys' time, and like I said at the top of the show, for the audience, this will be monthly. So we'll be bringing this every month to you guys. You can expect to grab this episode on the last Monday of every month. That just helps, all four of us kind of gather some really good topics to bring to you guys. So Collin, Wolfie, Eric, guys, thank you so much for your time and the topics that you guys brought. I thought this was pretty good. What do you guys think?
Amazing, man. I enjoyed it.
Have fun.
Yeah, I feel like we could probably
Awesome.
talk for the full 8-hour workday,
Yeah.
not stop. So look forward to next month.
True.
Yeah. All right. Well, guys, you all take care, and we'll see you in a couple weeks.
All right. Thanks, gentlemen.
Thanks.